So if you suddenly couldn't work tomorrow, could you still pay your mortgage next month? It's a slightly uncomfortable question, but it's a really important one. Because most people insure their cars, their phones, or even their pets. But the biggest financial commitment that most people make is their mortgage. And quite often it's not properly protected at all. And it's not because people don't care about their families. It's usually because nobody's ever really explained the risks. So today we're going to talk about something that most mortgage conversations generally skip over. What happens if illness or injury stops you from working? We're going to look at some real UK claims. What protection policies actually do, the biggest mistakes that homeowners make, and how people protect their mortgages properly. And some of the stories we talk about today might actually surprise you. Because the people who needed the protection most often thought they would be the least likely to ever use it. Let's start with a few simple facts. In 2024 alone, just one UK protection provider paid £751 million in claims. That supported 65,385 customers and their families. So that's not hypothetical risk, that's real people, real families, real mortgages that still needed paying. And behind every single one of those claims, there's a story. Someone who had cancer or a stroke, was injured in an accident, developed a long-term illness, or just simply couldn't work anymore. And the problem that most people face when that happens isn't the illness or injury itself. It's the financial pressure that comes with it. Your mortgage, your bills, food, energy, fuel, everything still has to be paid. But the income that normally pays for it all has suddenly stopped. And yes, if you're employed, you might get statutory sick pay. But in the UK at the moment, that equates to about £500 a month. Imagine trying to run your household on that. Mortgage, 900 quid, council tax, 200 quid, food, 400 quid, energy, 200 quid. And you've got £500 a month coming in. You can see how quickly that's going to get real, can't you? And this is exactly why mortgage protection exists. Not because people expect something bad to happen, but because life occasionally throws curveballs. And when it does, a little bit of financial breathing space can make an enormous difference. So let me tell you a little story about someone who many of you might recognise. James. Now, James was a plumber. He was self-employed, ran his own business. He had a mortgage and a young family. Now, one day, James started to feel a little unwell. And after a series of tests, was diagnosed with stage 3 bowel cancer. Now, the biggest problem for James wasn't just the illness. It was the fact he couldn't work for 8 weeks. And if you're self-employed, no work means no income and no sick pay. No employer benefits, that's for sure. Just bills continuing to arrive every month. Now, fortunately, James had taken out critical illness cover. So when he made his claim, the policy paid out a lump sum. And that lump sum payout made sure that his mortgage could be cleared off, giving the family financial security while he recovered. Now, the illness was still incredibly difficult to cope with, but at least financial stress was taken out of the equation. And this is a story I often share with self-employed clients. And that's because one of the main groups of people that mortgage advisors help is the self-employed. Tradespeople, contractors, business owners, freelancers. And unfortunately, being self-employed, it means there is very little by way of a safety net when the worst happens, which makes good protection cover even more important. And all the stories I'm telling you today are real. So let's take a look at another one. And this is one that really sticks with people. It's about a chap called Ryan, 31 years old. He'd just completed the London Marathon in under 3.5 hours, which is no mean feat. Not exactly someone who looked like a health risk. But a week after running that marathon, he's at his son's birthday party. And Ryan suddenly started to feel dizziness, vomiting, balance problems. And after tests, doctors confirmed something totally unexpected. Ryan had suffered a stroke at 31 years old. His recovery involved time in hospital, physiotherapy, rehabilitation, and his return to work was not immediate. Now, luckily, when he moved house, he'd taken out critical illness cover. And again, when he made that claim, it meant that his family could pay the bills and he could focus on recovery. He himself described it as the answer to all their problems, the light at the end of the tunnel. And this story highlights something really, really important. The people that don't think they need protection, they're the ones who feel healthy, young and invincible. But illness doesn't always arrive with warning signs. Sometimes it appears suddenly. I've been through the mill myself with my health, and you really don't know something's coming until it's too late. So let's talk about what mortgage protection really means. Well, when people hear the phrase mortgage protection, they think it's just one product. But actually, there's three main types of cover that protects homeowners. So let's break them down. The first one's life insurance. And this is the easiest one. If you pass away during the policy term, a lump sum gets paid out. And usually that lump sum is set to match your mortgage balance. So the payout clears off the mortgage and the family can remain in the home. It protects against that worst case scenario. And then there's critical illness cover. Now this pays out if you're diagnosed with a serious illness that's covered under the policy. Common examples include cancer, heart attack, stroke, etc. And those three conditions alone account for around 85% of all critical illness claims. The payout is a tax-free lump sum, and the money can be used for paying off a mortgage, replacing lost income, medical treatment, adapting your home. It gives people options when life just suddenly changes. And then there's income protection. And this is the one that's most overlooked. Income protection pays a monthly income if you can't work due to illness or injury, instead of a lump sum. So you receive regular monthly payments until you go back to work, or until the policy ends. And interestingly, the average income protection claimant is only 39 years old, which does surprise a lot of people, because most people assume that illness happens later in life. But it's not always the case. And over the years, I've noticed several common mistakes that many homeowners make. And they're surprisingly consistent. The first one is only having life insurance. Life insurance protects against death. It does nothing for you. And statistically, long-term illness is far more likely, which means many people are protected for the least likely scenario. And then there's the self-employed having no income protection. If you're self-employed and can't work, income often stops immediately. Yet many business owners have no cover at all. The self-employed are especially vulnerable and really shouldn't leave this stuff to chance. And then there's one of my favourites: buying the cheapest policy online. Protection policies vary massively. Definitions, claim conditions, additional benefits. Advice from a qualified broker helps people understand what they're actually buying. Cheap insurance is only ever cheap until you need to claim. And then there's not reviewing your cover. People take out policies when they buy their home and then just forget about it for 20 years or so. But life changes, children arrive, income grows, mortgages change. Your protection insurance should evolve with those changes. And any life event should automatically trigger a review. So when I'm working across areas like Hinckley, Lutterworth, Broughton Astley, Market Harborough, or even across the wider UK, I speak to lots of homeowners, most of whom are incredibly hardworking. Tradespeople, engineers, small business owners, contractors. People who have built their life through work. And a lot of them say the same thing: I'll deal with protection later. But protection insurance only works when it's arranged before you need it. Once the illness has happened, it's too late to put cover in place. And while we're there, the other misconception that a lot of people have is that protection cover is expensive. So let's put some numbers into context. A typical mortgage is around £900 to £1,000 a month. Income protection for someone in their 30s might cost £25 to £40 a month. So that's what? The cost of a takeaway. And for the price of that takeaway, you could protect the income that pays your mortgage. And if you think of it in those terms, it seems to make a lot more sense. If you've got a mortgage and you've got people that depend on your income, then protection isn't about fear, it's about options. Options to focus on recovery. Options to protect your family. Options to keep your home. If you'd like to understand more about what protection options might work for you, then feel free to reach out. My links are in the bio, and I hope you found this useful. If you found this interesting, then please subscribe to the channel where we talk about mortgages, protection, and generally making smarter financial decisions. Thanks for watching. Cheers. Bye-bye.